Welcome to The Business That Pays with Adam Tolliver from Artisan Financial Strategies, where we mind the business that pays you. In this podcast, we empower successful families and business owners to make informed decisions about their finances through courageous conversations. Through his expertise as a practicing investment advisor representative with Eagle Strategies, LLC, a registered investment advisor, Adam teaches you how to create a wealth ecosystem by combining a practical technical framework with your personal, family, and community values. Join us for this journey where Adam normalizes sustainable wealth building and gives you the keys to make courageous, proactive financial decisions.
This is the Business That Pays podcast. I'm Patrice Sikora with your host, Adam Tolliver. In a previous episode, we dreamed about suddenly coming into a sizable amount of money. Think lottery windfall or a business idea that just takes off. Adam discussed the importance of having a plan to deal with the estate tax. And he mentioned several celebrities who never did that. Adam, what happened to their assets, which I'm guessing were considerable?
Yeah, so it is really interesting, Patrice. And I think anytime I have this discussion, people are shocked at the types of names that are on this list.
Tell me.
Well, so we've got names like Elvis Presley, John D. Rockefeller, J.P. Morgan, Charles Woolworth, Frederick Vanderbilt. And then we've got a few sports families. Well, the Wrigley families, not just sports, they're Wrigley Gum, of course, but most people know Wrigley Field in Chicago. So the Wrigley family. We've got Joe Robbie of the Miami Dolphins, and Jack Kent Cooke of the formerly known as Washington Redskins. Jack Kent Cooke actually had his hand in quite a few sports franchises, but yeah, these are, and that's a pretty short list, honestly, but all of these families ended up leaving, all of these people end up leaving less than 50% of their wealth to their heirs because of estate tax issues.
Now, these are big names in money. J.P. Morgan, John D. Rockefeller, Vanderbilt. I mean, what were they thinking? Let me put it that way.
Well, so I think it's important to start with what the estate tax actually is. And so it's a federal tax on property transferred from a deceased person to their heirs. So it includes cash, real estate, stock, business interests, et cetera. So assets.
Okay.
And there's a couple things to kind of be mindful of here. Oftentimes, people will have a considerable amount of wealth, and it will include cash, yes, and it will include assets that generate income. But oftentimes, the largest thing on a wealthy person's balance sheet is something that is not liquid. It's not readily accessible cash. And that thing can end up being what puts them over the threshold of the estate tax exemption and causes an estate tax liability that needs to be paid by the heirs.
Are you talking like a business?
Yes.
I'm thinking.
Yeah, it can be a business or it could be real estate. So it could be a stadium, like in the case of Joe Robbie. So in Joe Robbie's case, it was both the Miami Dolphins and Joe Robbie Stadium, both considerably expensive assets on his balance sheet that put his estate well over the estate tax exemption.
You would think they would have people who knew this stuff.
And that is one of the great mysteries. But what I'll say is all the time we are relatively shocked or surprised by people with considerable resources who pass away and have disasters for estates. But in recent years, we've seen it with Prince. We've seen it with Aretha Franklin. We've seen it with Chadwick Boseman. And so unfortunately, it is not that uncommon. And so there are things that people can learn from these. And I actually even want to plug a great podcast that focuses on this exactly. I want to make sure I get their name right because, yeah, there's a lot to learn. Celebrity Estates which is presented by wealthmanagement.com.
I can play devil's advocate with the Chadwick Boseman estate.
Mm-hmm.
I would say perhaps he did not realize how quickly he was accumulating assets, perhaps, because yes, he had some minor successes, but his major successes came pretty closely together, didn't they? And maybe he just didn't understand how much his value was increasing.
Well, that's certainly possible. And what I will say is, from a planner's perspective, we often have a lot more urgency because we're more top of mind aware. And a lot of what we have to do, and when I say planner, I mean really professional advisors in general. So whether you're a financial planner or an accountant or an estate planning attorney, we have a lot more technical understanding behind why these are urgent matters that need to be taken care of and can't really be procrastinated on. For the average person, and I say average, we're talking about celebrities, but this is something that translates for everyone. You're living your life day to day. You've got a million things going on that are not top of mind, like, oh, I got to make sure my estate plan's in order. So while it may seem like as professionals, we're being naggy about trying to get people to sit down and take a look at these things, it's very easy for the average person, and especially the extremely busy person, to kick the can down the road because the assumption is that we'll get to it eventually.
Yes. What kind of a value are we talking about here? I mean, should I be worried? She said, well, laughing.
No offense to you, Patrice, but and no offense to me either. But today, as of now, not necessarily. So knowing whether or not you will have an estate tax liability can get pretty deep and technical, but for the vast majority of us, one very quick way to disqualify yourself is right now, if you have an estate that will be worth less than $11.7 million, which is the current estate tax exemption in 2021, then you are not in danger. And that's as an individual. If you're a couple, if the estate is worth less than 23.4 million, then you're fine. You will be exempt from the federal estate tax. And that is before accounting for, there are a couple of estate tax credits that you can use to take a chunk out of that as well. There are ways, but over the years,
I don't think I have to worry about researching it. Go ahead.
But what's important is that this is not a fixed number. So today's $11.7 million back in 1997 was $600,000.
Only nope. Back in the 1900s? The 1990s?
Back in the 1990s. It really only went over $1 million in 2002. So I think the last sort of big hike was in 2018, because in 2017 it was a little under 5.5 million.
Who sets these numbers?
This is a very political issue.
Okay.
And so you will see a correlation there, and it's a very politicized thing. If you are from the conservative side of the aisle, you will see and hear many of your representatives refer to it as a death tax, because that, of course, does not go over well with anyone being taxed for dying. And so it is a very political issue. And so it's something to be mindful of for that reason, because it's not a fixed number. And so for planning purposes, you've got to keep an eye on it. You've got to be mindful of if and when you do end up being in that threshold where you have an estate tax liability. So it's not fixed. It's not a set it and forget it type of thing.
I think I can tell my heirs I will do my best to make sure they don't have to worry about it.
They will appreciate you for it.
All right. So what are some of the strategies that we could take advantage of if we were really worried about this? And so I shouldn't make light of this, because there are people out there who are worried about this.
They absolutely are, and for good reason. And again, not because they're living high on the hog and they've just got all this money. It can be someone who owns a local car dealership that's successful. It could be local small business owners are in this position where, again, they own an asset, that business that may be worth 12, 15, 16 million dollars.
Mhm.
And so, and God forbid, from a succession standpoint, you know, if they need to leave something behind that a lot of people are dependent on for their jobs, and this isn't taken care of, that could cause an issue in the continuity of that business. And so yeah, it's definitely not to make light of. Of course, it is something that a lot of people don't have to worry about, but for those who do, the implications can be pretty catastrophic.
And you had a very good point there. It's not just their estate. It could be people who are employed by their estate.
Yep, absolutely.
So tell me, what are some strategies to look at?
So the first one, and of course, this is a very non-extensive list, but the first one is just having a comprehensive and ongoing estate planning strategy as a part of your overall financial plan. This is in that risk management bucket. As you know, that is one of our 4 pillars in financial planning. So protecting your downside, and your estate planning strategy needs to complement the rest of your financial plan, and it needs to be updated on a periodic. Some people will suggest somewhere between every 3 to 5 years, you need to be reviewing your estate planning documents and your overall approach. But we talked about this in your QB, your financial QB for all 4 quarters, but we want to just touch on this each year to make sure that we understand where things are. The second thing is that you want to account for liquidity in your estate. And so this goes back, and sometimes I do not like about our profession, how we use buzzwords that I don't think people necessarily understand. So for many people, when I say this, you're going to roll your eyes, but liquidity is cash, actual cash needing to be present and available. And this, Joe Robbie is the perfect example of this. They had an estate tax bill that they needed to pay. They need to pay the IRS. You can't pay the IRS in a stadium or a football team, nor would you want to. You don't want the IRS to own a portion of the Miami Dolphins. And so they had to sell in order to have the cash to pay the bill, which means they lost those assets as a family. That was not the desirable outcome for them. So having liquidity in your estate is typically something that's going to be solved by life insurance, which is something that we've talked about on the podcast as well. So that's a really important thing. If you have a large asset that may cause an estate tax liability, you can account for that estate tax liability through life insurance. The last strategy that we'll talk about here, at least, is charitable and familial gifts while you're alive. So taking the assets that exist and moving them out of your estate to lower the actual value of the estate to get it below that threshold is another strategy.
All right. What are we talking about when it comes to rates for the estate tax?
So the federal estate tax rate is progressive, and it ranges, and this is based on how many dollars in value your estate is over and above the exemption. So dollars above 11.7 or 23.4 million. So if you're $1,000 to $10,000 above, then those dollars are taxed at 18%. Now, of course, that's a small amount. So families of those types of resources would be able to pay for it.
Yeah.
But that's the bottom of the bracket. When we get all the way to the top, if you are $1 million plus over, it's a 40% rate.
Ooh.
It's a good time. Yeah. So as you can imagine, if you've got something of massive value on your balance sheet that's taking you well above and beyond, that bill can get pretty expensive. And it can dry a family out. Absolutely.
All right. Adam, is there something we haven't mentioned here you think we should?
Call me if you find your estate being worth more than $11.7 million.
Call you even if it's worth less than that.
Absolutely.
All right. And it's true. Most of us will probably not have to worry about that $11,700,000 threshold, but having a plan might be something to consider. And Adam, how can someone reach you?
You can reach me at workingwithadam.com.
And we will look forward to hearing any feedback from you on this episode. Follow or subscribe as well to Adam Tolliver's podcast, The Business That Pays, to know when the latest show is ready for you. I'm Patrice Sikora, and let's talk again later.
Thank you for listening to Business That Pays. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of the Artisan Financial Strategies or Eagle Strategies, LLC, a registered investment advisor. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial professional provider with any questions you may have regarding your investment strategies.
Adam Tolliver, registered representative offering securities through New York Life Securities, LLC, member FINRA SIPC, a licensed insurance agency. 1125 Cambridge Square, Suite C, Alpharetta, Georgia, 30009, 404-210-9311. Financial advisor offering investment advisory services through Eagle Strategies, LLC, a registered investment advisor. New York Life Securities, LLC, and Eagle Strategies, LLC are New York Life companies. Artisan Financial Strategies, LLC, is not owned or operated by New York Life Securities, LLC, or its affiliates. Neither Artisan Financial Strategies, LLC, nor its advisors provide tax, legal, or accounting advice.